Good afternoon, it's Christian Thwaites, Wednesday 23rd of November, the day before Thanksgiving, so happy Thanksgiving to everybody out there. This is going out on the Wednesday after a short week in the market, again still recovering. We're 2 weeks out from the election, still a lot of unknowns that the market is dealing with. Two major trends, of course, is that stock markets have been very, very strong. The S&P closed today, day before Thanksgiving, at a record high. It's up 16% since February and about up 6% from its pre-election lows. And small company, which many of you own, is up 42% since February, if you can believe, and up about 16% since the pre-election. Primarily because, remember, small company, domestic-facing stocks, relying on the US economy, whereas the S&P has a much larger international component. Let's just break down the entire post-election Trump economics and forward-looking world into two components. The market thinks two things are going to happen. There's going to be growth, which explains the rise in the equity markets, the rise in defense companies, the rise in infrastructure companies, the Caterpillars, the General Dynamics of the world, and those kind of large industrial stocks. It's one reason why the Dow Jones has outperformed the S&P. Second one is that there's going to be inflation. That means that Treasury yields have come off quite a bit, from about 1.8 to 2.3%. So the concern is that there will be inflation, although it's not here now, and that prices are already moving to compensate for fixed income investors for a higher inflation level. So that's the basic premise, those two working with each other. Now, we don't think that either is going to be quite as strong and robust as the market thinks. In other words, a lot of growth expectations in the equity market, we don't think they'll be quite as rip-roaring as high as people think they are. And the inflation that people are now pricing in, inflation break-evens are up to about 1.8%, basically means that's what people think inflation will be in the next 5 years, up from about 1.5. That, we don't think that will be as high as well because of other kind of inflationary pressures. So markets do not go up in a straight line, and what we've had pretty much in the last 2 weeks is a straight line in both directions. And here it is in the top right-hand corner. You can see equities, which is the blue line, which is the S&P on a total return basis, pretty much straight up. And this falling line is bonds going down. Now this doesn't happen without interruption. We still think markets have some way to sort this out. And a final thought on this chart is, which I showed a couple of weeks ago, is that there are times, and they're very important times, when equities go up. This is the blue line over in 99 and again in 06, and bonds go down. And it's exactly what we've got going on now. We haven't had that for about 5 or 6 years. So it's not incompatible or a contradiction that we could get a weak bond market and a very strong equity market. So that appears to be, on very limited data, just 2 weeks out, what we're looking at. We will be having a client conference call next week. Look for an invitation in your emails for that, going out very soon. It'll also be on our website, and hopefully you can call in and we can answer some of your questions that are going on. Before I sign off and wish you a happy Thanksgiving, I would like to thank my colleague Emily. And Emily, come into the picture. And this is Emily.
Hi, everyone.
She does all the work around here, and she does the video, and she helps me on so many things, and she's a very good financial advisor. Thanks very much. Happy Thanksgiving, Emily.
Happy Thanksgiving, everyone.
Bye, everybody.